Good morning, everyone. My name is Jeff Sharp, and I'm the director of the Ohio State School of Environment and Natural Resources. Thanks for joining us today. And for those of you who had signed up for the in-person component of this program, we appreciate you joining us in the transition over into our current virtual format. This year has been marked by just a need to be adaptable, and really appreciate everybody adapting to this format, given the sort of like place we're at with the current surge. And it was great this last fall when we were all getting together. I really felt like we had some momentum with the in-person meetings. So we'll make do, and appreciate everybody adapting and sort of moving onto this platform. As Joe and Cecil shared in their communications over the past week, our university is currently conducting a pretty massive operation of onboarding thousands and thousands of students into classrooms, dormitories, laboratories, and other research facilities here on campus. Though our university population is currently at a 92% or greater COVID vaccination rate and is actively testing those living and working on campus, we felt it was best to align this program with university guidance to prioritize hands-on student learning and to move non-student events online this week. Looking ahead, we are planning our February EPN breakfast with an in-person and virtual option. So hopefully we'll all be able to gather at the 4-H Center in February and welcome many of you virtually that have been joining us that way. I'm excited to share that as of last week, there are over 1,000 Ohio State students pursuing a Bachelor's of Science, Master's degree, or PhD in the School of Environment and Natural Resources. 240 of those students are pursuing the Environment, Economy, Development, and Sustainability Bachelor's degree, which we refer to as EADS. This degree is hosted in the School of Environment and Natural Resources in partnership with the Department of Agricultural, Environmental, and Development Economics and the Fisher College of Business. Our EADS major prepares students to address some of the most pressing challenges facing society today, like unprecedented environmental change, resource scarcities, and growing social inequalities. Through the EADS major, students gain practical skills in managing economic, social, and environmental change, so they are equipped with the knowledge and skills necessary to launch a career in sustainability in the private, public, and nonprofit sectors. In the 7 years since this major was created, upwards to 95% of the students in this major have acquired employment or enrolled in graduate or professional school within 6 months of graduation. To review the full list of where those students have gone on to pursue and advance their careers would require an entire program in and of itself. We'll hear from one of Ohio State's first EADS majors, Andrew Shea, in a few minutes. We still have a few folks logging on, so to make this as manageable as possible for participants, we've set this event up as a Zoom webinar, which means that there is no way for your camera to turn on or for us to pick up your audio. You are 100% muted and not on video. There are other opportunities for you to engage with our panelists and one another, both in this webinar and through an optional related networking session, which will follow this educational event. Please feel free to share your name and where you are joining us from today in the chat feature. And if you would like, add to that who you work for or what interests you about this program. When you go to type that in, please consider adjusting your chat message to send to all panelists and all attendees so everyone in this program can see. Today's event seeks to link together two important professional worlds and focus areas, finance and sustainability. Their linkage may be more important now than ever before. Data show that both overall global temperatures and economic inequality are growing. In this context of climate uncertainty, society is seeking strategies that finance sustainable development and unlock new opportunities to tackle the drivers of climate change. This includes the ever-growing and complex world of environmental, social, and governance investing, ESG, and other sustainability measures and investment tools, green bonds, and the decarbonization of holdings. Today's agenda is on the screen. Molly Bean, SENR Communication Director, posted onto the chat a link to view a full program overview through a digital brochure that includes full professional biographies of each of our speakers. I encourage you to read their bio statements featured in the brochure. The URL address to that brochure is featured on the screen now. I also want to thank the individuals who, through their registrations today, chose to sponsor a student for a future EPN breakfast. Those names are displayed in our digital brochure and on the screen now. Your support helps us enhance the connection students have to professionals and career-relevant knowledge. Thank you. Please notice on the screen some basic logistics related to our questions and answer format with the speakers. We encourage you to ask questions directly to our panelists during this program using the Q&A function that is located in the Zoom taskbar at the bottom of your screen. If you have a specific question for a speaker, then please type in the @ symbol followed by the speaker's first name. Our speakers will be typing their replies to your questions throughout the program. We will also have a dedicated panel discussion and question and answer session around 9 a.m. Please make sure you click the Q&A icon to activate that feature and to see any questions that our panelists may have answered. Dean Rose will speak next, providing an update on Ohio State's exploratory research group on sustainable finance and other university sustainable development initiatives. Dr. Bose will present next, outlining ESG, green bonds, and other investment strategies and their relevancy to financing sustainable development and decarbonizing financial portfolios. Sandy will discuss her work as a sustainability professional at AEP, including methods for gathering and reporting ESG data, specific programs within AEP related to finance, sustainability bonds, AEP's climate impact analysis, and the use of second-party verification systems. Last, Andrew will relate this program's topic areas to his work developing financial and investment products and solutions, perspectives on market trends, and future directions in the sustainable investment field. Thank you for being part of this program. I know both of you, Sandy, Andrew, and Paul, were intending to join us in person today, so along with everyone else, we appreciate you making the pivot to virtual. Again, please check out the digital brochure for this program for complete bios for each of today's panelists. Thank you, and it is a pleasure to hand this program over to Dean Paul Rose and the rest, the Robert J. Watkins and Procter Gamble Professor of Law with Ohio State's Moritz College of Law. Over to you, Dean Rose.
Well, thank you so much, Jeff. It really is a privilege to speak with you today, and I'm grateful for EPN for putting all this together, and I really look forward to hearing from our panelists and learning from their expertise. Being asked to speak about sustainability at Ohio State is really a daunting task. I mean, you can imagine that Ohio State is not only this collection of researchers and students, thousands and thousands of folks that are interested in this particular topic across lots of different disciplines, but Ohio State University is also a really large enterprise. And just the way that large enterprise thinks about sustainability has big impacts for the state of Ohio locally and even nationally. So I want to talk a little bit about some of the things that are going on at Ohio State, and a little bit about the work of the research group that I'm a part of, and hopefully that will set up some of the things that our panelists will talk about. So, written into just what this university is about is sustainability. We added some sustainability goals. Our leadership did at the university level. And so I'm just going to share a little bit of that vision with you. You can check out that link and you can read all about the sustainability goals. And just as an aside, if you want to just get a taste for the many, many things that are going on with respect to sustainability at Ohio State, just Google sustainability at Ohio State, and you will see as the top page that comes up, a page titled Sustainability at Ohio State that shows the dozens of different kinds of initiatives in the way that Ohio State manages its business, to research initiatives, and so on. So you can take a look at some of these things that I'll be talking about. But as I said, our leadership's really focused on sustainability and thinking about it as something that we can really create as a kind of culture, a campus to community, students to alumni culture of sustainability-oriented practices, from education to research to, again, really how we operate as a university that hopefully will transfer into local and global communities. And as a university, we really are trying to catalyze engagement, ownership, buy-in with our students, faculty, staff, but also through partnerships that we have on and off campus. So let me talk a little bit about some of the initiatives. Again, I mentioned that there are dozens of these across the university, across different disciplines. Among many others, there's a President's and Provost Council on Sustainability. There's the world famous Bird Polar Climate Polar and Climate Research Center. In fact, I mean, it's so well known. I was trying to, about a decade ago, attract a researcher that does environmental law to Ohio State. And one of the things that she was interested in learning about was whether she could, connect with the Bird Polar and Climate Research Center. She'd heard about it, and she really wanted to connect with those folks. And so I took her over there, and she's now part of our faculty and is teaching environmental law here at Ohio State. We have the Green Buckeyes program, which basically helps faculty, students, staff learn about ways that they can personally be committed to sustainable practices. And then, of course, we have the Sustainability Institute that really is trying to gather a lot of the things that we're doing across campus, especially a lot of the research that's going on across campus, and give it a kind of platform to help it be more successful and to help break down some of the silos that often exist between disciplines that may make us better able to solve some of the great pressing problems that we face as folks interested in sustainability. So these are the exploratory research groups, these practice groups or research groups that have been put together. And the way that they were put together was really, there was a call. This was really a bottom-up kind of initiative where the administration just simply wanted the Sustainability Institute to kind of help create these groups and just ask folks, what would you be interested in creating as a research group? And so because of my own research, I thought that it would be fantastic to have a sustainable finance research group. I mean, I'm a law professor. I was a trader, trading in equity and emerging market derivatives before I went into law school. And so I've always been focused on the sort of law and finance space. And the courses I teach are our basic business law courses, our securities regulation course. So I've long been interested in the way that we use finance to solve problems like these. And so I just suggested that as a topic, and they reached out to me and asked me if I would be willing to help run this group. And the group itself is, again, really, like most of these are, really an interdisciplinary group that is bringing together, in this case, scholars from business, from engineering, from political science, from environmental science, of course, just lots of different areas where we can talk together about how sustainable finance can help solve some of these problems. So my own research, I guess, just to give you a sense of how I connect to all this, I do a lot of work on green bonds. I have been part of a World Bank group that has been working on a document to create a sort of policy book or working book for governments to create strategic investment funds, which is one of the kinds of vehicles that governments use to invest in sustainable practices to make transition kinds of economies. And so I'm deeply, of course, committed to this as well. I should say that for our group, we take a pretty broad view about what sustainable finance means. We look at the European Union definition of what sustainable finance is, and we sort of built off of that. So sustainable finance just means finance that's taking into account environmental considerations, social considerations, governance considerations, ESG, which we're going to be talking a lot about over the next hour or so. So I just want to finish with one data point, I guess, about Ohio State's commitment to sustainability. And I guess you'd say that Ohio State's really putting its money where its mouth is, because recently they just committed to this huge green bond financing. So to have something certified as a green bond, basically it needs to be for a green purpose. You have to commit to the use of proceeds from the bond for a green purpose. There are ongoing reporting obligations associated with that. And so Ohio State went through that process for some of the financing for its new inpatient hospital that it's building. So this is a look at the rendering for that hospital. But again, Ohio State is not only a place where you can learn about this kind of topic about sustainable finance, but Ohio State as an institution is practicing sustainable finance. So I'll stop there. And again, thanks so much to EPN for putting all this together. And I look forward to hearing from our panelists.
Good morning, everybody. It's a pleasure to be here. I'm speaking to you from New Jersey. I teach at Columbia University in New York City in a program called the Masters of Sustainability Management, which we designed in 2009. We thought that at that time, we designed it right after the financial crisis because we felt that environmental problems and sustainability more broadly were an important concern after the financial crisis. We were thinking about ways to ensure long-term stable return. But at the time we thought, there'd be about 20 people interested in the program. We launched it, we designed 11 courses, and it turned out that we got hundreds of applicants. It was designed for people who are working in finance, in consulting, in government, nonprofits, around the New York City area, who needed skills in integrating sustainability into their workplace. And 70% of the students were full-time practitioners taking classes part-time. We got hundreds of students. We started out, applicants. We started out with an initial class of about 100 students. And over the years, it's only grown. We thought that it was just latent demand, but now we have 60 courses specifically designed for these professionals. I'm going to put in the chat a link which might be useful for those who want to look up the curriculum. The curriculum for all 60 courses that are available, the syllabi are available. So I'm only going to speak for about 10 minutes or so. But if you wanted to spend, 10 years on some of the details in here, I encourage you to go look at that website. It's of course a pleasure to be speaking at Ohio State, our neighbor, our near neighbor here in New Jersey. I'm often speaking to audiences in Latin America and Asia and Africa. And I know that Paul and Jeff spoke about reducing our carbon footprint. As you probably know, the average person here in the United States, we spend probably about 5 times as much on our carbon footprint as the average person in China. We probably spend about 6 times as much as the average person in Latin America, and about 8 times as much as the average person in India, and maybe 10 times as much as the average person in sub-Saharan Africa. So any efforts that we carry out to reduce our footprint in the United States has a 10-fold return on investment compared to our efforts in those other regions of the world. Let me share my screen a little bit and chat about some things. So let's see. Do you see my screen? Okay. What I want to talk to you about is sustainable investing broadly. Sandy and then Andrew will speak in detail about the issuer side and about the financial institution side. So I'll give you a very macro picture and not cut into that time. As you've probably seen, sustainable investing has grown very significantly over the last 10 years, similar to the story I told you about our program. Probably looking at these numbers, probably around 10% a year in growth in assets under management, which is much larger growth than in any other area of investing. Very significant growth in the US. Some of the other countries, you have higher growth, but those are off smaller bases. Of course, green bonds have taken off, and Andrew and Sandy will talk about that. What's important to note is that in the conversation, you'll note that in 2020 and 2021, there was no let-off. So unlike the 2008-2009 crisis, where we saw a pullback in green investment, especially in renewable energy, we haven't seen that at all in the 2020 crisis. Green bond issuance, while large, is still about 20 basis points of overall fixed income issuance. So there's a lot of room to grow. Now, sustainable investing can mean lots of different things. ESG integration is one of those, and probably ESG integration is a subset of a broader trend in ESG investing. These are some definitions that the Global Sustainable Investment Alliance uses in their statistics, the ones that I showed you earlier. Maybe we'll address some of the differences in Q&A. An important aspect of this, of the continued growth, the driver of continued growth, is the intergenerational transfer of wealth. So one of the things to understand is that over the last 70 years or so, the ownership of the largest corporations in the world, the ownership of the largest, of the debt issued by the largest corporations, doesn't sit with plutocratic billionaires anymore. It sits with what we call the citizen investor, much smaller investors, people who have their money in pension funds, in mutual funds, in 401k plans, middle-class people saving for retirement. And those people, it matters how the decision makers make choices about how they invest their savings. And so there's a shift of wealth from an older generation, the sort of baby boomers, to the next generation. And this is a report from Accenture that outlines the magnitude of that change that's ongoing. And you'll see that the largest change is taking place for people with net worth in the 500,000 to 5 million, which is not quite the mass affluent, but the affluent. These are not the billionaires, but the people who are worried about retirement, their homes, healthcare expenses, and so on. The ordinary investor, the retail investor, this is an asset management firm, just like Morgan Stanley, doing a survey on investor preferences. Ordinary investors care about environment, they care about social responsibility, about treatment of staff. Not only do they care about it, but they also believe that it contributes positively to return. One of the things to understand is that, and this is an important story that I want to just tell you, there's an American ecologist named William Beebe, who used to research in Latin America in the Amazon basin at the turn of the 20th century, so sort of 1920s or so, 1910, 1920. And you've probably all seen ants. We have them outside our house. When you see ants, particularly army ants, you'll notice that they travel in lines. They follow each other. That's because they listen. Ants have relatively small brain processing capacities, even relative to their weight. And so they don't do a lot of independent thinking. The way they survive is that they're attuned to pheromones from neighbors who think that they know where food sources are. And so they follow their neighbors. Now, William Beebe, a very interesting ecologist, he studied ants in Latin America, and he found that he discovered what's known as the circular army ant mill, which was that he found these ants following each other, but they followed each other in a giant circle. The circle might be about 2 kilometers in diameter. And so they didn't know that they were following each other in a circle. They thought they were going in a straight line, but they went in a circle looking for food. They all thought that the ant in front of them knew where the food was. And of course, no one knew where it was. And so after a few days, they all just died of exhaustion. So William Beebe came across giant circles of dead ants. That is what happens when we just follow the crowd, when not the crowd, but we follow we follow what we call the market. We follow, we don't do our own due diligence. We don't gather information. So it's in that context that you should think of sustainable investing. Sustainable investing is a way for individual investors to imagine what the future should look like, what sustainable development should look like, and then make choices in their portfolio allocation that helps fund the kind of change that would lead to that future development. Just following, investing the way the market capitalization is would not lead to any real change in the system. In general, I want to leave you with the understanding that ESG scoring companies tend to outperform their benchmark, not by a huge amount. This is over 14 years, and it's sort of a 30 basis point per year outperformance, which is significant but not huge. I want to dispel any notion, which I still hear a lot, is that people think that ESG, investing in ESG, sustainable investing, leads to a return penalty. It does not. In general, done properly, it should give you a modest excess return. There are more than 2,000 studies of the relationship between ESG and corporate financial performance. And the majority will show that there's a positive relationship between those two, and a small minority, about 8%, show that there is a negative relationship. And of course, remember that ESG is measured in multiple dimensions, in hundreds of different key performance indicators, and therefore you could certainly get some negative results. The correlation between these two measures is small but significant. It's in the order of about 15%, which is relatively small. This is out of a chapter in our book called The Financial Ecosystem. ESG excellence signals good things about the management of an issue. It signals competitive advantage, strategic leadership potential, enhanced customer loyalty, firm reputation, reduced operational risks, of course, energy efficiency, lower cost of capital. So these are all, in a world where investors are trying to judge issuer management, and in a world of asymmetric information, it's not always clear how good management is, because of course management will always try to look good. ESG signals are a way to evaluate the depth of quality in issuer management. There's studies that show that indexes of pollution prevention, green supply chain management, green product development positively correlated with stock market valuation multiples, return on equity, An important thing to keep in mind if you're a student or if you're a recruiting manager, employee engagement is highly correlated with financial return. As you know, today, information about employment practices is widely accessible. Everybody can go to Glassdoor and figure out insider reviews of employers. But we have much older research that shows that the places that are known as the best companies to work for tend to outperform very significantly, an excess return of 3.5% per annum beyond a four-factor attribution model. Okay, I have very little time, so I'm going to just skip through a lot of this, also because Andrew, I'm sure, will touch on it. Climate change does have a significant impact on many issuers. There are what we call physical risks, which are significant, but probably even more significant are transition risks. That is the regulatory response to government's estimates of climate risk, litigation, changes in the market, changes in consumer preferences. Issuers say their financials will be impacted. There are ways, of course, to parse out how that kind of change would affect specific financial statements, ways to think about how to measure the decarbonization level in the portfolio. I'm sorry, I'm just going very fast, but I do want to give lots of time for Sandy and Andrew, and we can always address this in Q&A. Some of the products that are being discussed and innovated in the financial industry are thematic portfolios designed to sharpen and focus investment on ways to decarbonize. Of course, things like resource efficiency and renewable energy, EVs and batteries, but also ways to enhance supply chain resilience, decarbonize products, automation, digitalization, and new market infrastructure. We could do a deep dive into specific aspects of decarbonization in particular industries. Let's jump ahead. The regulatory landscape is supporting that trend along with consumer and investor preferences. We see the SEC shifting towards that. The EU, of course, has a taxonomy, has regulation on the way investment funds say they invest in green activities. There are central bank responses to the climate risk that might affect systematic portfolios of the financial system, carbon pricing, and all the credit rating agencies now routinely incorporate ESG into their measurement of risk. There are, however, a lot of opportunities, I would say, for both issuers and investors in going much deeper into the data. I didn't get a chance to really talk about that, but I might share a resource with you on it. So at the moment, the level of data integration within ESG products and ESG understanding is very superficial, but there's a lot to do, and I think that actually creates a lot of work for the graduates of EADS and for our program as well. So let me pause there and hand it over to Sandy, and I look forward to talking to you during Q&A.
Terrific, thank you. Let me see if I can share my screen here. Good morning, everyone. Really good to be here with you. I really appreciate the opportunity to participate in this forum. This particular topic is near and dear to my heart because I have spent a lot of time not only on ESG disclosure, but also on sustainable finance just in the past year. So I'm just going to give you a little bit of overview of of AP's journey, what led us to develop a sustainable financing framework last year to support our energy transition strategy. But, I'll tell you right at the top that ESG has become a major business driver. It is an expectation. It's table stakes now. It's not a nice to do. And the expectations and the demand for disclosure are very, very high and constantly changing. And that is one of the challenges that we face. For those of you who may not be real familiar with who AEP is, you may be most familiar with AEP Ohio if you're here in Ohio. But AEP is one of the largest electric utilities in the country. We have 7 regulated utilities that operate in 11 states, and we have an unregulated competitive business. So we're really in 35 states. So it's a pretty big company. We are undergoing a major transformation of our system right now. We've set a goal to get to net zero carbon emissions by 2050. To do that, we have to really shift our generation portfolio. And since about 2011, we've retired more than 12,000 megawatts of coal-fired generation. And by 2028, we will retire an additional 6,500 megawatts. At the same time, we set a goal to add 16 gigawatts of new renewable energy by 2030. These are major shifts for a company like AEP. And that's actually, in the scheme of things, a really short amount of time to flip your portfolio so that by 2030, if we get regulatory support for that 16 gigawatts, we will flip our generation portfolio from being primarily fossil to primarily renewable energy. That is a major change for AEP. We are also building one of the largest, if not the largest, wind facility right now in Oklahoma. It's a 2,000 megawatt wind farm, and we will. And I'm going to talk about that because it's really directly tied to our sustainable finance framework. I will also tell you that when we engage with investors, climate change is the number one issue across the board, and I'll get into that. I wanted to share this particular slide to give you a sense of the landscape of ESG, what that looks like from a company perspective, and how and what we have to respond to on an annual basis, from frameworks and standards to data aggregators and ratings and rankings. Disclosure has almost become a full-time job. The biggest challenge we have with all of this is that all of the methodologies are different. So there's no comparing them, no apples to apples. All of them cover climate change, which means that, for us, and they all ask for it in a different way. So we may report on carbon emissions like 6 different ways because that's how it's being requested. Because of this growing demand for this kind of data, and really it's about looking at our performance. And for us, it's about how are you getting to that net zero and how fast can you get there? So about 3 years ago, to try to get some handle on this, we created an online ESG data center. And what we did was we took a look at all of the surveys that we were being asked to complete, looked at which ones are most relevant for AEP, what are the most material metrics within those surveys. And we got to that point by asking investors, where do you get your research on AEP? What's important to you? And so what we did was we identified over 250 metrics. That's a lot of metrics that are in this ESG data center. So that allows us to be more efficient inside the company. So instead of going to the same subject matter expert 10 times during the course of the year, we can put one ask with multiple due dates, and we only have to go to them once. So that was an enormous improvement for both us, but it's been very well received by investors who use it on a regular basis. It's a very crowded, landscape, and this is just, the data side of it. This is very data-driven. Quality matters. You heard that it's pretty superficial. There's no universal way of reporting on all of these metrics. What we do at AEP is we internally audit our sustainability report and all of our ESG data because we want to make sure that it is the most complete there's data integrity, and then it's accurate. And so we have this audit ready mindset when we're collecting data. But I will tell you that this is just the data piece of it. The other piece that's really important is your sustainability report, because that's where you can put the data into context. Throwing data out there alone is not enough. You need to put it into perspective of how it impacts your business. And so the sustainability report is really, really important. A few years ago, when we were working with the Edison Electric Institute, which is our major trade organization, to develop an ESG report for investors, we met with investors to do it. As companies, as utilities, we sat down and said, okay, we think they're going to want this, 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 and we had a laundry list. And the investors came back to us and they said, nope, 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 that's not what we need. These things better be in your sustainability report, because if we need them, we're going to look for them there. But here's the list of data points that we need that are decision useful as an investor or asset manager. So just to give you a little bit of perspective on what that landscape looks like and what companies like AEP are really faced with. And because of the overwhelming amount of data that we have to collect and report on, in 2017, we actually put our reporting process through Lean and came up with a standard reporting framework and process. And we created an accountability structure to go with that. So we have oversight that goes right up to the board of directors. So we have an Enterprise Sustainability Council. We have, then it goes from the Enterprise Sustainability Council to the executive team to the board of directors. And we also have a corporate ESG committee, which we put together as it's a cross-functional team with investor relations, legal from a governance perspective, risk management, finance and treasury, environmental, corporate sustainability, and then we bring in all of the others as we need them. But that corporate ESG committee meets on a monthly basis so that we can keep an eye on what's going on out there. You heard about the regulation. I mean, we have a lot of European investors. So that means we've got to pay attention to what's happening, let's say, in the EU and the SFDR, because they're asking, even though that doesn't apply to us per se, they're asking us to prove that they can prove that we're in compliance and that it's a legitimate part of their portfolio. So that corporate ESG committee also oversees our sustainable finance framework. And I mentioned that we do audit all of this, and we have partnered with our audit services team to help us really be audit ready whenever we request data. We're now also working with our risk management team to build a risk awareness mindset so that as we are identifying issues, emerging issues or trends, we can be looking at those from a risk management perspective. So there's a lot that goes into this, and I think that the things that we put into place position us really well for when the SEC comes out with its new mandates for ESG disclosure. That rule making is due to get underway this year, and we're fully expecting that we could see some mandates as soon as 2023. This whole process that we put into place reduced our audit hours by over 60% since 2017. We were at one point over 1,000 audit hours, which told us our process was broken. So now it's really buttoned up. We feel really good and confident in the data that we're publishing, whether it is to the surveys or through our sustainability reporting or in the ESG data center. So a very rigorous process and oversight in place. And this is pretty much what we do every year. The climate report, we do that every 2 to 3 years. We just issued a new report in 2021. It's a TCFD report, the Task Force for Financial Related Climate Disclosures. And it does cover transition, physical risk, and opportunity, but it also covers just transition. That's the socioeconomic impact of transitioning from a fossil-based economy to a regenerative, renewable economy, clean energy. And that was quite an undertaking because I co-led that process and wrote that report. But these are all of the different types of reports that we put out every year. We try to localize it for each of our operating companies. We also do industry reports, one for investors, one for customers, and we also report to GRI. We've been doing that for 15 years, as well as CDP, and we map our disclosure to SASB. All of those things are really, really important to investors. And why is all of this so important from an ESG perspective? Because as you heard before, it can affect your cost of and access to capital, your credit ratings, the insurability of your assets, how your shareholders will vote on your proxy, new business development. I've seen it come up in new business development. It also impacts your reputation and your brand. So all of this feeds into all those surveys that we respond to. It's extremely important. And we have full support from management and the board of directors. And the organization is really committed to this. And that brings me to our sustainable finance framework that we put together in 2021. Really excited about this. It was an indication of the money following the strategy and all of it aiming towards our climate goals. So there were two things that actually happened in 2021. The first one was that we renewed a credit revolver, a $5 billion credit revolver, and tied two ESG performance metrics to that revolver. One was our renewable goals and our progress on that, one of which is tied to compensation. And then we also tied our safety performance. And so we'll either pay more for that money or get a better rate on that money. But that was the first move we made into sustainable finance. And that was really exciting because it really demonstrated how, that we're really serious about this and we get this and that it's really important. So putting this framework together, we wanted it to be a single framework that we could use for multiple opportunities, maximum impact, if you will. So we designed it to be able to offer green bonds, social bonds, sustainability-linked bonds, and green loans. And within 2 days of launching this framework, we went out to secure green bonds in August, and then we went out again in October, and we secured $1.45 billion to support that 2,000 megawatt wind project in Oklahoma. Other things that we've built into this are electrification of our fleet. In order to get to renewables, you need other technologies like battery storage, if we're making investments there. Also, the potential for connecting renewables to the grid because you need to connect them so that you can deliver that energy to where you want it to go. And also some social issues around supplier diversity and broadband access, because we've got a lot of broadband activities going on in some of our states. So very excited about this. It really ties our financial performance and CapEx strategy to ESG. And very, very excited about that. And it gives us flexibility and it gave us access to new markets and new opportunities to secure capital to support that clean energy transition that we otherwise would not have had. So with that, I'm going to pause and I'm going to stop sharing and turn it over to Andrew.
Great, thank you, Sandy. I'm gonna share my screen here. So happy to be here. As Jeff had alluded to earlier, I was an EAT student in undergrad and actually completed my master's through Ohio State CFAS as well. So obviously a huge fan of the program and everything within CFAS. So I'm going to talk a bit about sustainable investing at large, but also about some of the work that Morgan Stanley does within the field. So kind of starting off with a background of sustainable investing and sustainability at large within Morgan Stanley. Similar to what Dr. Bose mentioned, actually, the group at Morgan Stanley was started coming out of the financial crisis. So going back all the way to 2009, which at that point, I don't even think I had a good understanding of what sustainability meant. Wasn't even at Ohio State at that point. So the group does have 10 plus year commitment to this kind of work and integrating that across the firm. And then kind of moving along that timeline, you can kind of see the firm, I think, started with a focus on capacity building and kind of thought leadership in the space that continues to today. But when you look at some of the other initiatives that have occurred over the past 3 to 4 years, you can see kind of some large movements in how we're tackling some of these global issues. So mobilizing capital towards low carbon solutions, committing to reducing plastic waste through various investments and different facilitation methods. 2020 now, we committed to reach net zero financed emissions by 2050. And then in 2021, we also committed to mobilize $1 trillion towards sustainable solutions. And if you look at that left column, these types of commitments and this work is occurring across the entire firm. So it's a global investment bank. We have the investment banking division. We have sales and trading. We have investment management, which is essentially the asset management arm of the firm. And then we have wealth management. And initiatives are occurring across all three of those sort of pillars that sit within the firm. And I guess I'll point out before I move on, you'll see a lot of the same logos that Sandy was showing throughout her presentation, as we both deal with those from an investor perspective, but also from a corporate perspective. You know, Morgan Stanley is a corporation just like any other. So we also are going through the reporting that Sandy deals with day in, day out as well. As far as kind of how we position ourselves on sustainable finance, we have a global sustainable finance group that sits at the firm level and drives the strategy and initiatives across the firm. So you can see, you know, this is kind of how we would think about our work, sitting in the middle here and then connecting with both external stakeholders as well as internal stakeholders, and then also on the investment side. Dr. Bose kind of showed some of this, so I won't spend too long, but investors are definitely increasingly caring about ESG and sustainable investing. You can see the graphic in the middle there showing the assets under management tied to sustainable investing increasing drastically within each region over time. And then surveys that we've done with investors, both on the institutional side and then also on the individual investor side, show that these groups are increasingly interested in sustainable investing and actually positioning their portfolio to include sustainable investments as well. So it's certainly something that you know, is important to investors, and as a byproduct of that, very important to Morgan Stanley. Again, kind of echoing Dr. Bose's kind of analysis on comparing the returns of sustainable funds versus not traditional funds or non-sustainable funds. I think you'll hear a performance myth or a risk myth that a lot of people will throw out. I think it's dissipating a bit over the past few years. But the bottom line is, I think time in, time out, there's really no evidence of a trade-off with sustainable funds over the long term. So you'll see we did a study going back all the way to 2004, comparing sustainable investing funds with traditional funds, and saw no evidence of a sort of lack of performance over time. We actually saw, especially in 2019 and 2020, median returns of sustainable funds outperforming traditional funds. And the other thing that we look into, and you can access this through the Sustainable Reality series that Morgan Stanley has published, is the downside deviation. So essentially not just looking at the upside of returns, but also at the risk that's involved in those investments. And we see a similar sort of story playing out there, where sustainable funds show slightly lower risk characteristics than traditional funds. So kind of backing up a bit, that's kind of some of the core tenets, but a question that might come up is, what actually is sustainable investing? How is it defined, and how are investors actually implementing these approaches in their portfolios? And it's not an easy answer. Sustainable investing kind of has a spectrum, and there's a lot of different ways to tackle it or implement it. So the history of sustainable investing actually started, most people agree, in the 1700s with the Quakers and Methodists implementing restriction screening in their investments. So they didn't want to be invested in things that didn't align with their beliefs or religion. And so they screened those investments out of their portfolios. And so that's kind of, I would say, the gateway to sustainable investing, minimizing negative impact through restriction screening. As you move along this spectrum, you can see it kind of step up. So there's ESG integration, which is actually, when you're making investment decisions, considering ESG criteria, so environmental, social, and governance criteria, to identify opportunities and risks. This doesn't have to be all altruistic. We see a lot of institutional investors implementing these types of approaches out of an opportunity or a risk framework, just like they would other investing data or criteria that they're making decisions with. The third bucket we see is thematic exposure. So this is really focusing in on themes and sectors dedicated to solving specific sustainability related challenges. And I'll dive into that a bit deeper later. And then all the way on the right is impact investing. And so this is allocating investment funds to specifically deliver positive environmental or social impacts. In this case, sometimes impact investing does, sacrifice some sort of returns to have that positive impact. But sustainable investing, just to be clear, runs the entire gamut of this slide. And so there are a lot of different ways to approach it and a lot of different definitions of sustainable investing. So then how does an investor actually invest sustainably? A lot of it does come down to ESG data. And so Sandy was talking from a corporate perspective. They're taking, how they operate, the disclosures that they have, and putting that into the hands of sort of some of these third-party data providers or collection organizations. Investors are then taking that information from those data providers and using that to inform investments. ESG data has blown up as a field. So any students that are on this, you should see this slide as job opportunities. There's a lot out there, especially over the past year. And so we kind of think about ESG data on two axes. One is the breadth. So some ESG data providers cover the entire spectrum of ESG issues or ESG topics. Other ESG data providers are very honed in on a specific topic, like physical climate change or sovereigns, or gender equality at the board and C-suite level, those types of things. The other axis, the vertical one, is frequency. So some ESG data is only updated once a year. So for example, we can get a yearly report on AEP's carbon emissions. Other ESG data is higher frequency. So there's actually news and sentiment data providers that are basically looking at news stories and tracking what commitments have companies made. Do companies have any controversies that have occurred recently? Things like that. And so, there's a lot of different buckets here and a lot of different sort of slots that ESG data can fit into. But there's a lot out there and a lot to deal with. And that's largely what my job is, figure out what is out there and how can we use it to create investment products for clients or help them understand what they're investing in. Getting back to the sort of thematic investing, we increasingly see clients interested in sustainable investment themes. So using ESG information aligned with specific themes to make sort of macro investment plays based on those themes. These themes can be environmental or social. We see a lot of interest on the climate solution side and sort of pushing towards both physical and transition climate solutions. And then we also see a ton of interest on, I think, the diversity and inclusion side as well. And sort of doing a deep dive, just because I think the most interest that we've seen from clients is on the climate side. Just kind of want to walk people through what does it actually mean to do this. So if a client comes to you and says they want to invest sustainably with a focus on climate, how does that actually play out? So again, it all starts with options. There's different approaches to how to do it. There's different metrics you can use. And so it's first honing in on what do you actually want to do? So the first question you would ask is, what is your primary climate objective? Are you trying to decarbonize your portfolio? And basically the focus there is minimizing your exposure to carbon intense sectors or issuers. And we usually see this with more of a risk focused lens. So investors who are trying to minimize their risk or their exposure to certain sectors or issuers that they deem to have, risk if carbon taxes came about or regulation continues at the pace that it has been recently. The other part of it is your primary objective decarbonizing the real economy. So actually decreasing emissions, global emissions in the real world, not just in your portfolio. I think this is generally viewed through two lenses from an investor. One is contributing to positive climate impacts. They actually want to have an impact on the world. And then the other is through a risk and opportunity lens, again, trying to understand who are the winners and losers during a transition. Sorry about that. And so you can kind of see this lines up broadly with that spectrum that I showed earlier. So you have restriction screening companies that are heavily involved in fossil fuels or are expanding coal operations, et cetera, or have high carbon intensity for their sector. ESG integration is kind of the next step up, where you're kind of taking that and looking at, do companies have emissions reduction targets? How do their earnings compared to the amount of emissions they have, and would they be able to withstand a pretty high carbon tax? Then moving into the thematic side, you'd actually be looking at, what are companies deriving revenues from, and are those revenues associated with positive or negative climate impacts? And then on the company engagement side, I didn't talk about this too much earlier, but another way that investors are increasingly approaching this is from the perspective of, if you're invested in a company, you theoretically have a say in how that company operates. You can engage with that company and you can help drive them towards more sustainable decision-making and more sustainable business practices. And so that's something else that we're seeing. Engine number one is an example of a hedge fund that's increasingly kind of taking this route. And they were able to kind of lead a charge to replace some board members at Exxon last year. So that's kind of a case study there. But yeah, I think that's a good stopping point there. And then we have time to answer questions.
Thank you so much, Andrew, Satyajit, and Sandy. Yeah, we do have some time, about 15 minutes or so for Q&A. So for those on the program now, you'll see if you click the Q&A button at the bottom of your Zoom toolbar, you'll see some questions that have already been answered by our panelists. I want to just throw a question right off the bat. We've heard a lot about green bonds. Dean Rose introduced the concept at the very beginning of the program. Could one of you give us just a general overview of what differentiates a green bond from a traditional bond type?
Yeah, generally, green bonds essentially have environmental key performance indicators. So think of it as a measurable stat associated with the company that increases its environmental performance. So for one example, a green bond could be a company needs to raise capital, and they are going to commit to increasing the share of their renewable energy generation with that capital. And so that bond is linked to that sort of statement of purpose or that key performance indicator being met. I don't know if Dr. Bose or Sandy, you have anything to add to that.
Sandy, go ahead, and then I'll jump in.
No, that's okay. Go for it. That was a good explanation.
Yeah, so I would just add that, it does increase the work a little bit for the issuer. There is a second opinion, as Sandy pointed out. It means there is a need to track the use of proceeds, often keep the proceeds in a separate account. And it increases the work. So actually we have a lot of graduates who work in this field. designing a framework for the use of proceeds, following up 1 year, 2 years, 3 years later to demonstrate that the proceeds were actually used for that purpose, and so on.
I'll just add to that in addition to tracking and disclosing the proceeds and where they went, we have to report the impact that those investments had as well. So it's not just the dollars, but it's the impact as well. And you're absolutely right. I mean, there was a second party opinion that we worked with Sustainalytics to get that done, and you have to comply with international principles for these types of financing instruments. So, you know, there's principles for green bonds and social bonds, et cetera. And we had to make sure that everything we did was in line with that. But it was well worth it. I mean, it was a process. There's no doubt, you know, there's work on the issuer side for sure. But we had banking partners that we worked with for both that. And then when you go to market, that was actually, I'd never been part of a process like that. It was actually pretty cool. You know, we did a marketing day, if you will, with investors to really market what we were doing and what we were trying to get the bonds, the money for. And then the next day, you know, everything it went out there and they made their decisions. But it's a fascinating process. If you ever get a chance to work on something like this, I highly recommend it.
Okay,
Andrew
thank you all.
and actually Andrew can probably support this, but green bonds tend to have a much higher oversubscription rate than the similar another bond by the same issuer that is not a green bond.
Yeah, two things I would note on apart from the structure of green bonds, sort of why are companies actually doing it. One is sometimes they're able to get a lower rate. So if you're, let's say, issuing a bond, and let's just for an example, your interest rate, just like any other borrower, let's say it's at 3%. Oftentimes with a green bond, you can move that down to 2.9 or 2.95%. So like a 5 to 10 basis point reduction, which is great for the issuer. The reason why that comes about is because of that oversubscription from investors. Investors want green bonds in their portfolio, and there's a demand for that. So often when we open up issuance for a corporate, often you're going out finding investors to fill that book. When it comes to green bonds, I think the door is getting knocked down, and there's really no need to go out and get the investors because they're all very eager to have that exposure to green bonds.
Okay, thank you. We had a registrant when they were signing up for the program who works for a large organization ask this question: how does one influence leaders of large organizations to change their investment strategies, even if there is a relative risk? Is anyone interested in fielding that question?
I can take a jump, a first cut, you know. So I think I had a slide about the signaling of ESG in general, about the quality of management. But I think the overall picture to keep in mind is that what has made us successful in the last 30 years is not what will make us successful in the next 30 years. The world is constantly changing. And that means that you always have to be running a few yards ahead of the competition. So when we actually have a class on sort of change management within organizations in sustainability. We bring in leaders from various large organizations, and what we see is that we need somebody, a visionary at the top, who's looking out into the future and thinking, what does my organization want to be in 5 years and 10 years and 30 years? And what does that world look like? What's my theory of change, as people will say, and how do I get there? And and of course evaluate the relative risks of being different from the crowd, of being that ant who walks outside the circle and looks for food on their own.
Thank you. And again, I'll point to the Q&A box. So thanks to everyone. I know Sandy and Andrew, you've been busy typing questions and answering questions in the Q&A. So there was a question that popped up here around crypto. Thanks, David Hanselman, for asking. Can you project whether and how the rise of crypto will impact sustainable investing and ESG efforts?
I could take a crack and then maybe Andrew and Sandy. So yeah, in the book, The Financial Ecosystem that I mentioned, we have a chapter 12 on decentralized finance. A large part, it's sort of larger than crypto, which is often referred to as decentralized finance, but there's a section on the use not so much of cryptocurrencies, but more of blockchain. There are many applications of blockchain that are really important for sustainability, especially in monitoring, reporting, and verification. Decentralized monitoring, some of the data providers that Andrew mentioned, especially those that are focused on real-time reporting in a decentralized way, have started to implement blockchain in that process. In verification, Sandy mentioned being audit ready. That's a context in which there's a lot of current investments in distributed ledgers to reduce the cost of auditing. We're seeing the piloting of cryptocurrencies in the context of trade finance, sustainable trade finance. As you probably know, many of the largest corporations don't actually do much of the work in-house. We didn't get into scope 1, scope 2, scope 3 emissions, but so much work is done by small and medium-sized enterprises around the world that are supplying supplying the larger corporations, but those larger corporations take on the brand risk associated with the supply chain. So trade finance is evolving to try, the trade finance are small short-term investments. It's not worth it to do very heavy due diligence on each transaction. It helps to be able to use blockchain in that context. So there are a number, I think we lay out some possible applications in corporate governance. There are a number of applications. This book was written 3 years ago. There are already many examples in the real world like it. So I would see impacts more from blockchain than specifically cryptocurrency, but there are some cryptocurrency platforms that are working on this.
The only thing I would add to that is not necessarily crypto specific, but on the blockchain side, we are seeing interest in differentiating certain commodities, basically a sustainable version of commodity versus the traditional version using blockchain technology. So an example would be if you take a block of gold and are able to track that block of gold on the blockchain, and see where it's actually coming from and if it was sourced sustainably and how that mine operates. And then at the end of the day, when that block of gold has traveled around the world, you can track that where it was originally from. So that's kind of one example of something that I've seen being pitched from the commodity side with blockchain.
Great, thank you all. At the beginning of your remarks, Dr. Bose, you explained about the citizen investor and retail investors. That might relate to some of the folks here on this call, and that their preferences for ESG were relatively high. And that included one of the measures, and I'd put this maybe under the S for ESG, related to executive and staff pay and gaps around that. Can anyone comment a little bit on what is that measure, the social component in ESG? What does that mean for transparency? What does that mean for the future of organizations? Can you elaborate a little bit more on how companies are addressing issues related to workforce and perhaps other opportunity gaps that some evidence is suggesting is growing in the country?
Yeah, there have been a number of so your first part of the question about the retail and citizen investors. So of course there are retail investors. they have not been as focused on this as the institutional investor that pools the assets of the citizen investor, so the pension funds. But there have been a number of proxy resolutions to get large companies to disclose information about pay gaps, say, between the median worker in that corporation and the top 6 paid workers in that corporation, the CEO and the CFO and so on. So that the ratio between those is often seen as a way to evaluate these corporations. And of course, there are differences across industries and how geographically spread out you are. And it is a very simplified metric, but it's one that's useful. Other social metrics, do the corporations provide sufficient sick pay? This came into high focus in the last couple of years. There is a organization called Just Capital, which does rankings based on polls, essentially asking ordinary people what they think about particular companies' pay practices, diversity practices, and so on, and ranking them. And that's a sort of a version 2.0 of the earlier study I referred to, using, the Fortune best companies to work for in the US. So there are a lot of those, and it varies also by jurisdiction. What's important in the US is very different from what's important in Europe and Latin America. Depends on the corporate governance structures, civil law versus common law jurisdictions, and so on.
Mm-hmm. Yeah, I would just add that there's definitely a growing, and has been for some time, pressure on companies to be more transparent around workforce issues, and it goes gender gap, and pay equity, it's diversity and inclusion, it's your safety performance, because that can be a proxy for governance of a company. There are a lot of different social issues. I'm proud to say that AEP has been really, really transparent in reporting on these issues for many, many years. I participated in a roundtable with one of these third-party research organizations a couple of years ago, and I was shocked at how many of the large companies, Fortune 500, really don't disclose their diversity data. I was pretty taken aback by that. I don't see, maybe I'm just, naive, but I don't see why you wouldn't. But, I was pretty surprised by that. So there is a lot of pressure. The pandemic and the social and racial unrest certainly ripped the Band-Aid off and made those things even more important. And we're going to see that continue to grow. That is not going to go away anytime soon. So that's a really important, how a company treats its employees, the benefits it provides, what it pays its employees, the culture of the organization. If you're looking to work for a company, especially if you're currently a student, it's going to be, you're going to be looking for the companies that are doing these things and doing them well. So as a company, we have to be on top of that, and we have to be sensitive to the fact that the world is changing around us, and we have to change with it. And otherwise, we will not get the top talent, and we won't be able to retain employees. And that's, in our business, as it is with any company, that's a real issue. We're a very technical focused, technical skilled organization. I just can't say enough about how important the social aspect of ESG has come to the fore in the last couple of years. We never got questions from investors on diversity and inclusion and, things like that. And all of a sudden we started getting them. And so it's really, really important.
Yeah, I think it ramped up drastically during the summer of 2020 and hasn't let up since then. I think the response from corporates has been positive. I think a lot of corporates weren't even aware that they weren't reporting that information, or that information was not available, and we've seen them pivot on that. I think the other aspect is we've seen data providers really hone in on the information. So some of the traditional providers and the stalwarts like MSCI, ISS, Sustainalytics, VigioIris are offering that information, but there's also some really cool kind of single issue data providers focused on that as well, like Equally. And then I would also say there's some interesting approaches too, where you can actually access Glassdoor data or information, for example. So there's kind of increased interest in how are companies treating their employees, both from are they doing the right thing with their employees, but the perspective, but also from do companies that treat their employees correctly, does that pay off in the long run?
Mhm.
I think to sort of reiterate these points, when you think about today, we're in a different world today than say 20 years ago, which is as a company, you rely on a range of stakeholders. You rely on customers to buy your product, employees to produce those products, communities in which you live and operate, governments that tax you and provide services, investors that provide capital. And if you think about all those stakeholders, the one group that is most crucial today, that has very little competition, is the employee. Those are the ones that are scarce for many reasons. One is that the reason for success for a company has nothing to do with how good you are at making widgets. It has much more to do with, are your employees thinking about how to innovate? Are they engaged with you? Capital is the world, especially in the US and the OECD countries, that world is awash in capital. There, as a result of unconventional monetary policy, there's no shortage of capital. Interest rates are, underwater, basically. Real interest rates are negative 6% these days. So the only thing that we're constrained on is people. The working age population in the OECD countries is a smaller and smaller percentage of the overall population. We have a much more complicated set of industries. There's much more deregulation and change, disruptive change, and that means there's a need for understanding the situation. That's partly why there's been such an increase in the need for education around this. But it means if you are a prospective employee, you are going to have your choices of places to join. It's even today. So and especially today, and I would expect that to get better over time.
All right, thank you all so much. That was a terrific panel. It was great to hear from you. And I will point everyone over to the Q&A where you'll see the answer to the great question: is the light bulb behind Sandy LED? To find out the answer, click on
Yes.
question and answer. It is. Thank you all. Over to you, Jeff.
Thank you, everyone, for a wonderful program. Eye-opening to me. This is kind of a new territory for me, so I learned a lot of words, new vocabulary. I think there's a lot more for me to learn in this space. So I appreciate everybody taking the time to sort of like walk us through this. And I think I'm excited that there's going to be future resources circulated on this topic through the EPN, and that there's going to be additional programming here the next couple of days for people to probe in this more depth. So thank you for really opening our eyes to some very interesting topics. As is our EPN tradition, we want to recognize you with a certificate of appreciation and thanks for your participation today, albeit in electronic form. Each of you presenters will receive from us something. I'm not sure, Joe, an electronic form, I guess. One purpose of today's program was to connect two fields that we don't always get to connect: sustainability and finance. The EPN was designed to help individuals to learn for life and to connect our community. While we were disappointed to have to pivot today's exciting program into a virtual format, I'm very glad that there are some networking opportunities that will follow. Joe and Cecil will be switching over to a Zoom meeting here shortly to host an extended networking program on this topic. I will show more details about how to join that networking session shortly. Please note that for those who love the coffee breakfast and in-person interaction that EPN events are known to offer, we are planning for our February, March, and April programs to include catering and in-person learning opportunities in addition to remote connection options. Our February EPN event will address the coexistence strategies that large carnivores make to live among human populations. Dr. Jose Vincent Lopez Bao will explain how he utilizes large mammalian carnivores among the most controversial and challenging group of species to conserve as research models to inform management decisions in our crowded and modern world. Mr. Tom Schmidt, the newly appointed president and CEO of our Columbus Zoo and Aquarium, will make his first official visit to Ohio State to provide an update on the world's most critical carnivore conservation topics from the perspective of one of the planet's most recognizable zoo and aquarium systems. You will come away from this event with greater knowledge on how ecological conservation and management problem-solving strategies can successfully blend creative and collaborative scientific research. To register for our February EPN breakfast event or virtual streaming options, visit EPN website or go directly to the hyperlink Molly shared in the chat. Save the date for March 22nd as well. Last year, the United Nations put out a global call for community leaders to step out and ask what water access means to their friends and neighbors and to make records of water's true value in our communities. A dynamic group of Ohio State researchers and professional filmmakers answered this call, traveling the past year across Ohio, asking water utility managers, experts, and advocates in communities, big and small, urban and rural, about the challenges of water affordability. The result is And for Water for All, an educational documentary examining the opportunities and challenges that governmental and non-governmental entities are facing today to secure clean and affordable water and what to expect in the coming decade. Save the date to view this film and join the conversation on World Water Day. This event will be immediately followed by an extended educational networking event hosted by our partners at the Water Management Association of Ohio and Ohio Water Resource Center. This event is designed for a general public audience as well as experienced water resource professionals from federal, state, and local government, private sector consulting firms, nonprofit organizations, and academic research and teaching institutions. We've got a great lineup of programs for you coming this year. Please visit epn.osu.edu to become a member of the EPN to stay aware of future program or opportunities, or reach out to Joe and Cecil directly. And you'll also find information about our Signature Earth Day event, which will be coming up April 20th, that will involve the current CEO of the Nature Conservancy, as well as our University President Johnson, and many more. So look for details on our website.